Ever wondered how credit works in America's financial system? Well, let's break it down. At its core, credit is a financial agreement, a contract, if you will, between two parties. It's a bit like a handshake agreement, but with a lot more paperwork. Now, here's the interesting part. This agreement allows one party, let's call them Party A, to provide resources such as money, goods, or services to another party, Party B. But here's the catch. Party B doesn't have to reimburse Party A immediately. Instead, they promise to pay back these resources, usually with interest, at a later date. This arrangement is built on a foundation of trust. Party A has to trust that Party B will fulfill their promise to pay back the resources in the future. It's a bit like lending your friend a book, trusting that they'll return it in good condition. So, in essence, credit is a trust-based financial agreement that allows for the exchange of resources with a promise of future repayment. Now that we understand what credit is, what are the different types of credit? Well, there are two main types of credit, revolving and non-revolving. Let's start with revolving credit. This is the type of credit that replenishes up to an agreed-upon limit as long as the customer pays off their credit regularly. Think about it like a well that refills itself, as long as you're putting in the effort to keep it replenished. Credit cards are a common example of revolving credit. On the other hand, non-revolving credit does not replenish once it's paid off. Imagine it as a bucket of water. Once you've used up all the water, that's it. You don't get any more unless you go out and get another bucket. Student loans, car loans, and mortgages are all examples of non-revolving credit. And there you have it, the two main types of credit, revolving and non-revolving. Why is credit so important in America's financial system? Picture this, you found the perfect house or your dream car, but the price tag is hefty. Without credit, these big-ticket items would be out of reach for many of us. Credit empowers consumers to make substantial purchases with the understanding that they'll pay the amount back over time. It's like having a financial bridge, helping you cross over to your aspirations. Now let's flip the coin and look at businesses. Businesses, small or large, often rely on credit to fund operations, invest in new projects, or expand their reach. It's a catalyst that fuels their growth and in turn stimulates job creation and economic development. And on a grander scale, credit is a cornerstone of America's economy. It keeps the wheels of commerce spinning, facilitating trade, and fostering economic growth. In conclusion, credit is not just a financial tool, but a vital part of America's economy, aiding both consumers and businesses alike.